So in the lab, 90 minutes to complete. And it's closed book. I'll give you scrap paper. You can use, of course, a web browser because that's the only way you can get to connect. And you can use that login information, you guys. And everything else, I mean, it's the same as the first one, all the same stuff. Start the exam, you enter connect, select midterm. Oh, that should say 2, not 1. So here's the information. Just chapter 2, 3, and 4. Okay, nothing from 10, 11, and 12. Equity securities, so here's all the topics you need. And I'll change this on Blackboard. Chapter 3, business combinations, and it's all 100%. And then chapter 4, we're doing the questions from it today. It's going to be non-wholly owned subsidiaries, so it's less than 100%. That's everything you have to know. Please note that if there is a bargain purchase, so negative goodwill, I will tell you. Okay? Just because if you accidentally screw up and you get a bargain purchase and then try and do entries, they're all wrong, right? So I will tell you. So if you're getting a negative goodwill and it doesn't say it's a bargain purchase, and then calculation, all that stuff. Don't forget your entries on the parent and sub separate entity books. So breakdown of midterm 2, it's pretty much 30% chapter 2, 35% each on 3 and 4, 90 minutes, 70 marks, very similar to the timing for midterm 1. And the exam consists of multi-part problems, so there's a lot more little questions to ask. So I'd be splitting bigger problems into little ones. Problems are longer, more involved, especially more involved. There's more information to go through. So build up your speed, you guys, especially since everything you're doing in chapter 3 and 4 is directly related to 5, 6, 7, and 9. And those are heavy chapters, so you've got to know this inside out. Quickly to finish in time, how to prepare the exam. Just completing the notes isn't enough. You've got to do problems. And I suggest working them in Connect, since your exam is in Connect. So the more questions you do, the better off you're going to be. Your speed will be higher, plus all that weird wording, get used to it, because we're just going to keep adding to problems in the next 4 chapters. Okay? Exam. Yeah.
Now, can I just ask, so for the short question, do you mean like small calculations, or?
Yeah, it might be like calculate goodwill, or it might be calculate NCI or something like that. Yeah, so a short question would be like a fill in the blank kind of thing. Okay, other questions, you guys? Good question. Because of course in my head, short necessarily mean what you guys. Anything else? I'll check my email on the weekends, or this weekend, and same with Monday and Tuesday. Okay, so that's about the exam. So we are going to do some parts of problem 4.2 today. And try and kind of get this cemented in our head. Okay. So we've got the balance sheet on December 31st. Here they are. Really squished together. And then we have the fair value of the identifiable net assets of the sub, all on December 31st. So, assume on January 1st, year 2, PAR acquired shares with a cash payment to shareholders of the sub. And today are case 1, 2, and 5. So, for each of the 5 cases, prepare a consolidated balance sheet as of the date of acquisition, the end of acquisition day. So, can we just jump right to the balance sheet? There's 2 calculations we have to do first. What are they?
Goodwill.
Always goodwill first. Now we add this chapter because we bought less than 100%. We have controlling interest, but the other 20%, 60%, not 60, 40%, that's all going to be non-controlling interest, or NCI. So we have to calculate NCI at acquisition. And for this chapter, that's all we know. Starting next chapter, we'll move beyond. And then you can do the consolidated balance sheet. Okay, so just some things I'd do first. Here's the fair value, here's the carrying value. So I would calculate FV minus CV just to make it easier when we get to the balance sheet. So you have a reference. So is cash the same? Sorry, you guys, is cash the same? Yep, it's good. AR the same? Yep. Inventory the same? No. Carrying value is 21. Fair value is 26. So our inventory is going to go up by 26 minus 21, which equals Does that make sense? Okay. So the plant, 51 and 60 down here. Notice it's net because there's no accumulated depreciation. That's the way you like it, because then you don't have to cancel one out. But we'll look at that. So plant goes from 51 to 60,000, so it goes up by 9,000. Trademarks go up from 7 to 14. Current liabilities are the same. Long goes from 20 to 19, so it goes down by 1,000. Any questions on that? Now, of course, you could have done, doesn't matter. I'm doing here because we have to use these same numbers over in 3 cases. Okay. So we know these took place. PAR acquired the shares with the cash payment to the shareholders of the sub. So I'm just going to ask a question that's not on here. What are the entries for the parent? Well, they're giving away cash and they are getting common shares, right? So I debit common shares. It's investment because there's someone else's shares, okay? Be careful with that. Don't accidentally debit common shares. And then whatever the dollar values are, it changes in all of them. And if we do entry for the sub, so on the sub's books. Yep.
For the investments, always going to be like investment slash sub, and for connect purposes possibly.
Good question. If investments get, otherwise investments, okay. Good question. I think they're not consistent on Connect, so sometimes they are and sometimes they aren't. Yeah. Which is frustrating. I find that very frustrating. Okay, entry for sub. Did we pay anything to the actual sub on their books? No. Here's the sub sitting here. We went to their shareholders and paid entry. Paid shareholders of sub. It says entry. No entry, paid shareholders of sub. So that's just a little review on the entries on their books. Okay, so let's look at case 5000 to acquire all of the common shares of sub. Okay, so what are we calculating first? Goodwill. So case 1. Okay, we start with for goodwill. Consideration given up? Yeah. And just remember, we bought 100%. How much should they give up? 95,000. Everybody good with that? Okay. Now we're doing, from here on in, you guys, we're doing the long calculations. Unless it's just a question that says calculate goodwill and there's one blank for your answer, you can do whatever you want. Or if they don't ask for it. Like in this one, they're not even asking for it. You go right to the balance sheet, right? Okay, less carrying value of sub. We're going to take assets minus liabilities at the carrying value. So 8,000. And what were our liabilities? 30, right? The 10 plus the 20. Okay. That's 58,000, so we subtract to get, which is called the acquisition differential, or AD. So acquisition differential is the amount you paid over the carrying value of the assets. That's always going to be split into two things. Changes in fair value are called fair value differential and goodwill. So take away less FV minus CV, or fair value differential now with this is where you go back to our little page here, and we're just going to put all the ones that are different. Always bear in mind, you guys, with questions, additional information, it could also say Oh, hey, there's also a patent that isn't on the original subs books. Okay? Then you'd have to add it in. Okay, so we have inventory. And it went up by 5,000. We have the plant, 9,000. Whoops, sorry guys. Then we have a trademark. That went up by 7,000. Long-term debt. That went down by 1,000. And you scan over your question again, double check they didn't add a patent or a customer list or something like that. And they didn't, so that's it. So now we have to figure out if we're going to add or subtract these. So what's the little rule? They're positive if debit or credit. Debit, credit. Are we going up? To make it go up, do we debit or credit it? This is way back to like chapter 2 of 311. It's a debit, so it's positive. Plant going up is also a debit, so it's positive. Trademark going up is also a debit, so it's positive. Everybody almost always gets the assets right. So liabilities, you can be doing it fast, you forget. They're backwards, right? Liability going down. How do we make a liability go down? Debit it. So these happen to all be added. Okay with that? Okay, excellent. Because you will be doing about 10 billion more of these before the end of the term. Isn't that exciting? Just think how well you'll know it by the end. Okay, so since they're all added, that was to 22,000, I hope. And that means goodwill is 15,000. Questions? Okay. So that was our first calculation, our little goodwill. Second calculation would be NCI. So how much is NCI in this case? 0. Why is it 0? What percent did we buy?
100%.
100%. So there is no non-controlling interest. There's just us. We own it all. So no NCI because we bought 100%. Okay, now we can do what the question's actually asking for, which is the consolidated balance sheet. Okay, why don't you guys give it a try? Give it for 5. This looks like the simplest thing. Oh, you just add, subtract, or whatever. That's where people can screw up. So just give it a try and then we'll go over it. Do you guys need the numbers back or did you all find the question? Numbers? Okay. Should get total assets, 359,000. Okay, let me know, you guys, if you have questions. Okay, guys, so doing the balance sheet, the parent's financial statement at carrying value, so even if they give you fair value of the parent, we don't care. Then we add the sub's carrying value, and then we either add or subtract as necessary these guys. Okay? Now, is it possible you could just add this and this? Yeah, instead. However, the reason we separate this out, I'm just going to cover this up for a sec, you guys. The reason we separate this out is that in the future, so when we start moving to year 1, 2, 3, we have to do something with these. So inventory, it's going to turn out goes negative the next year. Plant and trademark will have to be amortized every year, and it goes off in the next year. We're not worrying too much about it at this level. Okay? So that's why we separate these out and think of this as a whole separate little thing, because starting with chapter 5 and then 6 and 7, we have to do different things with those. So we wouldn't start at acquisition, we'll start at year 3. So you go, okay, 3 years in, if this was over 10 years, then we divide it by 10 times 3, and that's the change. Okay? So that now, you can just dispense with that. But okay, so let's look at the statements. So I'm just going to cover liabilities up for a sec. So this is pretty straightforward. Parent, sub, what's this minus 95? The acquisition, what they had to pay, okay? So that would be an easy one to forget. Remember, if they paid in shares, we wouldn't have that. It would be under common shares, we'd be adding it. Everybody good? Little parent sub, inventory parent sub plus the 5,000 up here. Okay? Does everybody see where those numbers are coming from? Which do you think is the most easy to forget out of this whole assets? Goodwill. So don't forget the goodwill. Generally, the asset side is good, the financial statements, because we all can understand them. Liabilities and equity is where most of us make mistakes. So liability, same thing. Parent sub, and there's no FV minus CV. Long-term debt, parent sub, FV minus CV. Now remember, common shares is only the parent. Retained earnings for now is the parent right off the books. So make sure you can, if you have it. Now, remember, NCI is with liabilities. So this, I put it in here, you didn't really need it, but this is where it would go. Whoops, with equity. Any questions on where those numbers came from? Okay, so make sure you try at least a couple before the exam.